together a quick video looking at drawdown accounts, because I think this is something that a lot of people get confused and frustrated about, really, understanding the difference between an annuity and a drawdown account. So I want to cover a little bit about how drawdowns work, and in particular, if you were going to invest some money in drawdown, how that might look for different risk scenarios, for being really cautious to being, want to take a bit more risks for a higher return. So let's have a look at some charts. So we'll look at two different investments, both of which are really popular with people investing their pensions. And the first will be familiar, it's the S&P 500. This is the 500 biggest companies in the US stock markets. And the second is the overnight return, probably a little bit less familiar. This tracks how banks lend money to each other overnight and is quite reflective, really, of having your money in, say, for example, a really good interest rate savings account. And I've chosen these two because they're quite different. The S&P 500 is higher risk, higher volatility, higher return, whereas the overnight return is lower risk, lower volatility, and a lower return. Now, we don't have to invest in either one or the other. We can invest in both at the same time. So we'll look at three different scenarios. In the first one, we'll split our pension money 50-50, half of it in the S&P 500 and half of it in the overnight return. Then we'll put 90% in the S&P, and in the final scenario, we'll put 90% in the overnight return. And let's have a look how this will fare if we go back to the last 17 years. So imagine we put our money in this 17 years ago. So I'll start with a 50-50 balance here. And this website here shows us how it would have performed. And what I really like about this site is it will tell us how many years it would have performed well, how many years it would have performed poorly. It also tells us what about how it performed when we take into account inflation, for example. So the website provides lots of different information, but the one I'm particularly interested in looking at first is the summary, which will tell us how much, on average, over them 17 years, this portfolio of 2 shares has done on average over them years. So if we scroll down to the summary, here we are. So we can see that 6.36%, that is the average return that this investment would have made us over the last 17 years. So now let's have a look on what years this portfolio would have done badly and how many it would have done well in. So here's the chart coming up here. So we can see here that it's mostly green. They are the years where we've performed well. The red lines are where the portfolio's actually lost money. I can see here 2008, where we had the housing crash, and then again 2021-22 for the COVID dip there as well. So quite predictable years where, most portfolios would have performed badly. But I think what's interesting is how many of them years actually give us a positive return and how many gave a negative. So let's have a look at the 17. And you can see how much in these 17 squares here represents how much we made or lost in each of the particular years. So we can see quite a few years here where we made, significant amounts. Okay, so I think this chart is quite useful. It shows the balance of positives against negatives here, and we can see that there's obviously a lot more positives than there is negatives. The one I'm really interested in is, let's have a look at what this would have returned us when we factor inflation in. So this is really interesting for me. So the blue line, that's the nominal amount. That's how much it made literally. And the red amount there is, the red line is how much it's made actually in real terms when we take inflation away. So we can see this has gone up, really considerably over that period. So that if we'd have had this mix of shares over the last 17 years, it would have done particularly well. That doesn't mean, of course, that it will do just as well over the next 17 years. And certainly these kind of investments are not something you'd do, for 2 or 3 years. You would be looking to invest for longer periods. So let's go back now and let's rerun the numbers, but with a different balance between these two. Let's go for a much higher risk one, where we'll go 90% in the S&P and only 10% in the overnight return. So this is obviously going to be a much riskier portfolio. We'll see more reds on here, but it'll be interesting to see overall what the return was. So 90% and 10%. And then we'll go through the same charts and see how this portfolio fared. This will take a second here. There we go. It's recalculated. Let's scroll down now and see how we've fared. So we'll go to the summary first. And in the summary here, we can see that the annual return has been 10.22%. Oh, that's excellent. That is a fantastic number. Anyone would be pleased with that kind of a return. But it is, higher risk, and we can see higher risk here that the bars go deeper in the 2008 dip and in 2021-22 dip there as well for COVID. So there was a bigger dip in them periods, but there's also higher returns. So the green bars are higher as well. And we can see here that for this portfolio, it's done extremely well overall, where with just a few years where there's been a dip. And although they were, fairly significant when they did dips, because this is a higher risk portfolio. So in particular this one here, we can see that was a real significant loss in that one particular year. So again, for me, the balance of these indicates that these shares have done particularly well when they've done well. So we've got more green than we have red. But for me, the one that makes a real difference is, let's have a look. Once we take inflation into account, what was the real performance of this split portfolio with 90% of it in the S&P? And here we can see that the real has jumped, from £10,000 there to 40,000. So absolutely magnificent return there if you are prepared to take that higher level of risk. So that's the real turn. So remember, the blue line is the nominal and the red line is the real return. However, what if we wanted to go for a real risk averse one? So let's put the vast majority into the overnight, the safer investments, and let's see how the portfolio performs there. So we'll go 90% in the safe overnight return and only 10% in the higher volatility S&P 500. So let's set that up here. So you can see here I've set them to 10% S&P, 90% overnight. And let's go down and have a look at the same charts again. So we'll start with the summary and let's see what the overall return was over the 17-year period. So here we go. So you can see here that the return was only 2.09%. When we were talking the other way around with the S&P being 90%, we were over 10%. So that we can see how returns here, although a lot safer, are significantly lower. So we can see the amount of risk we take really has affected the amount of returns we've got. So we should see a lot less red bars now when we go to the charts. And here we can see, yeah, there's very little really in terms of red. We can see almost everything is green across there, because we're effectively taking a very safe route, almost like putting it into a bank, but 10% was invested in higher risk for us. So let's have a look at that another way. There we can see that, again, very small amounts of red. Most years we did make some money, as we'd expect. So again, the impact of inflation, this is the really important one for me. Let's see how much we would have made over the last 17 years if we had chosen this balance of a portfolio. Wow, look at that. So the red line, what it shows us is actually we've lost money here rather than gained money. Once we take inflation into account, we've actually lost money. I think the lesson we take from that is don't be too risk averse. You can put your money into a real low risk, really secure investment, and find out once you take inflation into account, you've actually lost money over the period. You haven't gained anything in your investments. So it's all about balance, isn't it? My portfolio looks a bit more like the 50-50 example we just went through. I'm actually at the moment 60% in really safe and 40% in kind of more higher risk, kind of big index. I've actually got 5% in very high risk as well. And that's just a decision I made. And I quite enjoy looking at the stock market. Now, that 5% I've got in really high risk shares, they're individual companies, which is not something that most people advise people do. Don't invest in, Shell or any of the British companies as an individual. Generally, you buy into indexes like the S&P 500 or the FTSE 100 or the FTSE 250. That's where most people tend to invest their money. Spoiler alert, that 5%, it's highly unlikely it's going to perform better than, just because it's higher risk doesn't mean it's going to perform any better. You won't beat the markets generally. It's over 90% don't. So I hope you enjoyed this, and I hope demystifies a little bit some of what a drawdown account is. And if you've got any comments, any observations, any questions, put them in the comments below, and I'll see you on the next one. Cheers.